Okay, many of you will know this name. The first thing I need to say about Carfinco is why didn't I buy more? And these four arrows indicate the appearances of Carfinco, and this is our fourth annual conference, and here they are. So, and this is our only TSX listed client that's presenting tonight. When Carfinco first presented in October of 2009, the stock, or at that time it was a unit, as it was an income trust, it was trading around $1.65. If you had bought it, as some people who are here tonight did, between distributions, specials, and dividends, up to this conference, keeping in mind it was $1.65, you would have received $1.69 in cash back. And on top of that, you'd also be up around $8 per share. The thing about this management group, it's tried and true. It says publicly, repeatedly, that it will maintain at least a 20% annual growth rate. It has an unblemished record of 13 consecutive quarters of record earnings. 4 analysts have buy ratings of $11 to $12, with this group having raised its targets several times already over the past couple of years. Management recently gave shareholders an early Christmas present and increased the monthly dividend to 4 cents from 3.5 cents, and in October of 2009 it was a penny and a half. So based on the current trading price, it's around a 5% yield. There are only 24.65 million shares issued and fully diluted, and a large percentage are owned by management and directors. The average daily trading volume in 2011 was about 29,000 shares, and this year it's 45,000 shares. And with that, I would like to introduce the Chief Operating Officer, Troy Graf.
Thank you, Grant, for that wonderful introduction, and thank you for having me here this evening to speak about Carfinco. So I'll try and get through everything in 15 minutes. The slide deck, to do that, I'll speak quickly and go over a lot of topics. But to start with, I'll give you a bit of background on Carfinco. We were incorporated in 1996, and at that time I had come over as well with Tracy Graf and Rick Hewson, our Senior Vice President of Operations. All three of us have been with the entity since it started up in 96. We actually originally started with the financing of car repairs, so that was our key focus for our product, and we tried to grow that entity. We couldn't grow that portfolio large enough, so in 2000 we actually converted over to the financing of used vehicles. We thought that was a great fit for the skill set we had in place at that time, and over time we've grown that product. In 2002 we actually converted into an income fund. We were one of the early converters, and we actually converted when we were listed on the TSXV, which was unique at that time as well. In 2005 we became listed on the TSX, and in 2012, so January of this year, we ended up converting back into a corporation due to the change in the tax rules, and have now become Carfinco Financial Group. So just to go back to what Grant was saying, since we last presented last year after the release of Q2, since then into this the release of Q2 in 2012, the finance receivables indeed increased to $181 million, an increase of approximately 19% year over year. Revenues for this last quarter were close to $18 million, an increase of close to 23% year over year. And the earnings per share were 22 cents in Q2 2012, an increase of close to 30% over the previous year. Loan originations continue to grow. In the second quarter of 2012, they were at $36.8 million, a record for that quarter, and we've released information that July and August were 13 and 14.2 million respectively. So on the road to another record quarter for Q3 for loan originations, and all the while retaining our high ROE above 50% per annum. And we anticipate releasing Q3 of this year the first week of November, so just in a couple of weeks. So just to proceed on here. Some of the key investment highlights. We're uniquely positioned and highly profitable auto finance company. We operate in what's called the subprime finance market, and I'll get to that in later slides. We've delivered a consistent growth of 20% year over year. That's really our baseline growth, and that's all been done with organic growth. So since day one, all of our new business has been sourced organically. And currently we have 18,700 customers, approaching 20,000 active customers in our portfolio. We provide unique programs to the subprime auto market in Canada. One of our unique programs that we certainly don't have direct competition on is it's called the Go Plan, and we call it a dealer participation program. So we basically buy contracts in at a deep discount, so approximately 20%, but as high as 60% discounts. And based on the performance of that paper for that specific dealer, they may participate in additional back-end money on that pool. And what that does is it helps both us to shield credit risk. So if that pool of accounts does go south and has high losses, we have good coverage on that credit risk. And then if the losses are low, the dealer also benefits by being able to receive additional purchase price on that pool of accounts. So over time, we've created a system of credit control checks and balances. The real benefit there is that because we operate in the subprime market is different than the prime market with higher volumes. We have more stipulations, more information required to book those accounts onto our system. And over time, we have learned and impounded all that information into our current processes. Next, we have a strong management team. As I mentioned when I opened up, three of the senior team, Tracy Graf, Chief Executive Officer, myself, Troy Graf, Chief Operating Officer, and Rick Houston, Senior Vice President of Operations, have all been with the entity since the beginning. Our VPs of account management have both been with us for over 10 years, and our newer CFO has been with us for 3 years and previously with our audit firm. So that continues to be a strength through the entity. There continues to be barriers of entry. Over time, we've continued to invest heavily in information technology. We certainly focus on best practices. We attend a lot of conferences. We actually don't attend conferences in Canada because we don't have a large peer group here, and any peers we do have in Canada come down to the U.S. as well. So we are members of a couple of U.S. associations, and we attend their conferences and really try to pull their best practices and put them in play in Canada. One of our key focuses right now is creating data warehousing, bringing all of our data in-house. Not an overly exciting project, but what that it does allow us to do is to increase our ability to do data analytics and draw more information out of our systems. Some of our, probably in the half decade, our big investments in technology. One has been a dialer system to create efficiencies in our collection department as we actually carry and maintain and keep our own paper, so we don't securitize our paper off to other entities, we keep it. The other is GPS starter interrupt technology. We started testing that in 2006. So what that is we actually on over 95% of our loan originations, we have a device installed that has multiple features. One is we can communicate a warning to that device, so when the customer turns on their car, if they're past due, it'll emit a beep, and it's a warning to please contact Carfinco and resolve your past due. It also, if it escalates, we're able to use a starter interrupt system so the customer can no longer restart the vehicle after it's been disengaged. And then we also have GPS technology, so if we're in that situation, we can locate the vehicle quickly and have quicker repossession turnover. We're also vertically integrated and do all operations except for bailiff services. That's the only thing we can't do in-house just due to licensing. The next slide here is a summary of our senior funding. We have a banking syndicate with Bank of America, which is managed out of New York, Wells Fargo Financial Corporation Canada, and Bank of Montreal through Harris Bank in Chicago. Bank of America has been partners with us since 2000. They actually came in 2000 with an $18 million credit facility. As you can see, we've been able to increase that successfully at every renegotiation. We're now at $130 million. And I just want to highlight that we were able to bring Wells Fargo into our deal in December of 2008, and if you can recall, that was really the height of the credit crisis, and we're able to successfully bring that partner into the fold. And I just also want to highlight from this slide, our maximum leverage ratio is 3.5 to 1. Management certainly doesn't want to get close to that range, but we'd certainly target that 3 to 3.25, and we're currently below that in the 2.85 area. Next slide, just showing that Carfinco is geographically diverse, 60% Western Canada, 40% East. At this time, I'm just going to focus a bit on that 20% growth that I spoke of earlier. One source of that growth we're getting right now is expansion into the province of Quebec. We've been there and growing a portfolio, and it's been successful. That province presents its own unique challenges, and we're working to work within that and build a successful portfolio in that province. And as well, we've really focused on adding business managers, so regional marketing people across the country to service underserviced areas, and that's been successful in increasing our loan originations during the year. And we continue focusing on improving customer service as our entity grows. So while all this is happening, we still feel, we are targeting this 20% growth to still be in the D market space, which I'll get to, but not having to expand out of that. This is Carfinco's competitive landscape. You can see that major competitors in the past have left the Canadian market: HSBC, Wells Fargo, AmeriCredit. TD is in the non-prime market, mostly through an acquisition of VFC about half a decade ago, and same with Scotiabank, who purchased Travelers Acceptance a number of years ago. And we have Rifco, who is also an Alberta-based company, which has a smaller portfolio, but we don't directly compete with those companies for the majority of our loan originations. As you can see from the slide, approximately currently 90% of our business is in that D market, and we really have no national competitor in that D market space. The next slide is just a brief overview of the Canadian credit bureau market. So every Canadian is tagged with a 3-digit score that indicates their credit worthiness. So the top 2 tiers, say a credit score above 680 would be considered prime paper. So 65% of the Canadian marketplace would be in that prime space. Then non-prime would really be that 620 to 679 score. And you can see the green bars are actually the proportion of the Carfinco portfolio that lies in those pockets. You can see that the vast majority of our portfolio is in the D market space, and we continue to target that market space. This is just a brief slide of our customer and loan profile. You can see we fund the typical Canadian, 38 years old, 5 years at their residence, 4 years on the job, average income. Our typical loan is smaller than you'd see with other finance companies because of that focus on subprime. You'd be in that 12,000 range. We actually maximize our term at 60 months. We haven't extended to the 72s and 84s that if you pay attention to the US market, they're leaning that way to try and extend more and more credit over time. Our average payment is lower at $400. You can see our interest rate is 29.5%, and that's actually been our key interest rate even when we were doing auto repair financing. We've been at that rate, which is really the high end of the consumer interest rate in Canada. The federally mandated maximum would be 59.5% in Canada on an annual basis. When you wrap our admin fee into that, our effective rate becomes closer to 33%. Next slide just visually shows the growth in our finance receivables portfolio. As I mentioned, we're at $181 million at the end of Q2, and a 20% growth rate for the end of the year would put us a little above $200 million at the end of the year. And you can probably, to bring out of this slide, you can see in 2008, 2009, really the effect of the recession for us on the portfolio side was really a re-entrenchment. We tightened up on credit and made sure we got through that credit crisis in a healthy manner, and our growth capped off. Next slide is really a representation of our growing earnings. The green bars show our earnings per share. Now the 2010 were pre-tax because we're still an income fund, whereas the 2011, 2012 are after tax. You can see, we're really focusing on, I want to focus on the regular cash distribution, which is highlighted in blue. As Grant mentioned, we just moved to a 4 cents per month regular distribution, which would be 12 cents per quarter. So really looking at maintaining a maintainable monthly dividend. We're very conscious to keep that as something that we never have to re-entrench on. We're certainly balancing our capital requirements. We're balancing our ability to grow at 20% per annum with our leveraging requirements. Even at our current distribution rates and our current earning rates, our leverage ratios keep going down while we're still distributing cash. So the next slide's going to show our return on equity, and here it is. So what I want to highlight there is, again, 2011 and 12 are after tax. The other ones were pre-tax. Focusing on 2008, we had a $1.9 million loss in that year, but I want to highlight that out of that, there was a $1.5 million mark-to-market and a $5.7 million adjustment to our allowance. So if you add those non-cash entries back, we were still positive 5.3. So I really want to speak very quickly about the recession. So we certainly were hit from different sides during the recession. Had our customer hit by increasing gas prices, and we had used car oversupply, had our used car prices collapse, which affected our loss severity at auction. And that's really what caused our change in our allowancing and that non-cash hit to our statements. Going forward, we certainly don't see those types of events hitting us as hard. The customer's more used to the increase in gas prices, and we're looking to minimize those credit risks over time. Next is our share capital. Again, 24.6 million outstanding, no options or warrants outstanding. Next, the leadership team. Again, I've spoken to the management. The board of directors has been invaluable with a wealth of experience over time. Again, highlighting David Rosenkrantz from Patica Securities Limited. He's our current chairman, but the board has provided valuable assistance over time. Again, our stock chart really indicative of our consistent ability to create revenues and net earnings out of those revenues. Certainly our focus is on continuing that trend. What are our analysts saying? Again, the list of stock, $12, $11, $11.5, $12, and certainly continuing to support those values by focusing on our 20% growth and focusing on operating efficiencies. To wrap up, really why Carfinco? Again, consistent positive growth over time, targeting our 20% growth rate. We certainly intend on maintaining that 4 cents per month dividend and being very cautious on how we set dividend policy and how we support it. Multiple consecutive quarters of record normalized net earnings. And again, large management and board ownership, which aligns our interests with our shareholders. So thank you very much for having me here tonight. I certainly appreciated being given an opportunity to give Carfinco's history. And if you have any questions, please feel free to ask me afterwards as well. Thank you.